Joined by the top team of DSP Blackrock Mutual Fund here, right here on ET Now. They've just launched a very interesting kind of a passive product this time. This is their first passive product. I have the entire team of DSP Blackrock with me. We'll be talking to their markets and about the interesting product. But Anil, to you first. This is the fund's entry into passive now. The Nifty product, it's different in a way because it will have not market weighted components, but equal weighted. Talk to us about how did you go about launching this product?
Sure. The concept is very simple. What we realized is that for any core investment principle, to buy any stocks, one would try to buy companies which are leaders in their market segments, companies which have the potential to ride through business cycles. So let's say one such basket or one such portfolio of stocks could be the companies which are forming part of the Nifty 50. Typically companies which are thought as the flag bearers of the Indian economy, the top 50 companies representing the overall market. However, what we thought is that that particular portfolio results into a heavy skew towards companies which are having very large market cap, or in that sense free float market cap, which have less of ownership by the promoters. So results into, let's say, weightage of 9% into HDFC. I mean, HDFC twins together like a 17-18%, followed by some of the other large names like ITC, and then some other banking stocks again come in. So it also translates into a sector level concentration, like financials as a sector today is about 36% in the Nifty 50. So what we thought is that by changing the asset weighting slightly, tweaking the formula whereby all the stocks are equally weighted, what we come up with is a portfolio which is a smart strategy which has a potential to outperform the Nifty 50, because now it's a portfolio which will meet one more basic principle of investing, that any good portfolio should be well diversified across stocks and sectors. So my stock, which was about 9.6% in the portfolio, now is 2%. My one large sector, which was about 36%, is now 20%. Right. So good diversification.
I think this is a very smart thing you guys have actually gone ahead with. But it comes at a time, Kalpen, when the market is going through a bit of a correction. How are you guys going about assessing the investor appetite? How are the flows overall in your own funds right now? Because some time back you had shut one of the most popular offerings, which is the small cap, the micro cap. How is it going otherwise?
I think we still see very strong investor appetite, and overall in the last 7-8 months we've had 8,000 crores of net equity sales across all our products, even though microcap was shut down. The idea of shutting down microcap was to respect the fact that we want at all points in time to be cognizant of the future experiences of our investors, and we don't want past returns to be a driver for investing for the future. And then microcap had a large size, and liquidity tends to be very low in this segment, plus valuations were high. Having said that, flows remain very dominant. I think the investor mood at this point in time still is that structurally the India story is fairly long-term in nature, and corrections seem to be an opportunity to add more to equities. More importantly, investors are investing through discipline, through monthly SIPs, and history has shown that timing markets has been futile. Deciding when will markets go up or down is astrology. The best thing to do is to have a reasonably long time horizon of 7 to 10 years and diversify across time. And as you diversify, you go through various market cycles. We feel that in that journey, bringing a very disciplined idea like this with a concept of smart beta and equal weighting, which also automatically rebalances the portfolio, will fulfill the 3 tenets of investing: invest for the long term, invest via SIPs, and invest in 50 large companies in an equal weight concept.
In fact, I think it also completes your bouquet of offerings also in a very smart particular manner. Anup, I'll come to you now, because the market is wanting to know with every expert we speak to on the channel what they think of the correction which has come in. And more than that, the trigger, the growth scare, which turned out to be the trigger for this correction. What are you making of what's panning out right now in the markets?
Sure. So, as usual, we are not particularly keen on taking very short-term views as far as the market is concerned. So these corrections are par for the course. I think equity markets, have an inherent volatility that everybody has to recognize and respect. And what we're seeing is a bit of a trend across emerging markets at the moment. So, corrections I think are pretty much par for the course. But the more important thing that you mentioned was on earnings growth, because that eventually will drive the long-term performance of the market. And we continue to be struggling in the short run with earnings growth. We haven't had a particularly good quarter, and now we have these GST-related issues. But I think as we move into the later part of the year, because of a low base, we will start seeing some improvement in corporate earnings. And we're clearly hoping that that will extend into next year as well, particularly with a lot of the challenges around the banking system and a few other sectors pretty much being behind us. So we are pretty positive that sitting where corporate profits are as a percentage of GDP today at 2.5, 2.6%, which is a 13-year low, I think from here profits should be growing faster than GDP at least.
But Anup, surely, but as a market participant who observes developments happening in the economy and the market, the way some really senior people in the industry, ex-finance ministers, are talking about the collapse of growth in India, and of course some numbers have actually shown some growth has stalled. As a market participant, do you think the market started pricing in too much in terms of earnings growth, revival, etc., and all of that adjustment could be painful? How investors should be cognizant of that right now?
So I think the way to see this is that while whenever you're implementing any new sort of reform, there's obviously going to be some adjustment that the economy will have to go through, and that's a phase that we're going. In the long term, though, it's all very positive effects, and eventually the whole design around, let's say, GST is to improve the ease of doing business, and eventually corporate profitability will also get better because of removal of a lot of bottlenecks in the system. So I think you've got to look more at the longer term impact of what is happening rather than looking at it right in the short run. So there will be pain for a few quarters, as we've mentioned, but I think eventually it will actually have an impetus to earnings, and that's what we've got to think about more than the shorter term effects of that on the market. So corporate earnings growth, I think, will go beyond this. I'm not sure this will drag down structurally corporate earnings growth in our country.
Right. Kalpen, back to you. Right now we've seen last 3-4 years, the SIP book of the industry has grown from 1,500 odd to almost 5,000 now. And some innovation work is happening at funds like yours, launching such a fund. Where do you see 2-3 years far out the SIP book of the industry going? Because some of the brokerages are coming out with very lofty targets for the market. They expect financialization to increase flows to the market. What is your trend observation?
So, we always look for past performance in investing. When I look at past experience of 2 decades, a lot of these things don't have predictability and they don't probably even matter. The trend definitely is that investors are seeking equity as an asset class, partly because it has done well, partly also because a lot of education has been done that if you really want to beat inflation over long periods of time, this is a good asset class to be in. So in any phase of the market, there is a combination of greed and need. What we are seeing is some money is coming out of greed, which will fluctuate with market fluctuations, but some money has come with a lot of maturity and evolution and a lot of education done by the industry and distribution partners and people like you and media, where we've been wiring investors to say that look for next 10, 15, 20 years, invest for decades, not for months, invest for decades, not for years, look through fluctuations, and if equities didn't have volatility, they would have been a fixed deposit.